A bit later, Bianco of Bianco Research weighing in on the supply concerns, saying the following. The Fed's massive purchases of bonds over the last 5 months is actually shrinking the size of the bond market available to the private sector, keeping bond market volatility near all-time lows and long-term yields trending sideways. What upsets this dynamic is the Fed exiting or a return of inflation. Bianco joins us right now. Jim, great to catch up. Let's talk about it. Are we seeing some fatigue, some indigestion in this bond market?
Yeah, I think we are beginning to see it. As the quote you started with, it's amazing to think that the Bloomberg Barclays Aggregate Index, which is the benchmark for the bond market, is about $1 trillion smaller than it started the year, even though we've got all this massive issuance and this huge budget deficit. And the reason is the Fed has bought more than has actually been issued, which has caused the market to shrink. Well, all this issuance is starting to catch up now. And as we move forward, the Fed has kind of found a glide path at a much lower purchase level, but the issuance is not going to stop, especially at the government level. So we're going to start to see supply now start to become the issue. And that's why I think the beginning we're seeing indigestion, especially out at the 30-year sector, which is where the Fed is the least active of all of the maturity buckets where they could be.
So, Jim, that last piece that you mentioned, I think is probably the most important piece. We've been talking about this, you and I, for the last several months. Every pocket, every corner of fixed income is distorted. Where's the clear signal? Is the clearest signal, relatively speaking, the very long end of the Treasury curve?
It could be, because that's where you've got the least amount of activity. But you're right. I mean, it's important to understand, whenever you talk about the fixed income market, especially in the United States, the largest player is an insensitive price buyer in the central bank, whether it's in corporate bonds, it's in short-term securities through QE, whether it's in now even in municipal securities. But so where are they not playing as much? Out at around the 30-year sector as well. And there, when you start to see rates start to head higher and you start to see volatility kick up, that might be the one place you could find a signal for this bond market.
So, Jim, let's build on this. The purest play for the underlying economy in the market right now, where do you think it is?
Oh, for the whole underlying economy, the purest play, that's a tough one to play, because I think it's probably going to be somewhere away from the financial sector altogether. Something like gold would be a play where you start to see rising prices there. Gold is not necessarily indicating inflation, but it is indicating concern about the financial system or financial risk, to maybe say it better, and that's where I think you've seen the prices go up. But if you're looking at where you want to look in stocks, or if you want to look in the bond market, it gets a little tougher because of all of those distorting signals, because of those price-insensitive buyers.
That's the challenge for many people at the moment, Jim. How to reconcile their macro view with their market view. And as you sit there struggling to reconcile the two things, you'll start to make mistakes, because quite often you can't reconcile the macro view with the market view. And that's not new post-COVID. That was a story that persisted for several years going into this crisis as well. And I just wonder, Jim, how difficult it is to avoid getting married to your macro view and allowing that to shape almost exclusively how you express your views in markets at the moment.
You know, when you ask the question, I'm thinking, yeah, it is very difficult. And if you want to know a real-time example of how difficult that may look to Washington. There's no doubt that the economy stalled in mid-June and that it has been struggling to advance. Maybe it's not W-downing again, but it's certainly not moving forward. And yet we can't get a deal together. And one of the reasons I've even postulated on things like Twitter, too, that we can't get a deal is the stock market's at an all-time high, and congressmen look at it and say, hey, there's no problem. The stock market's at a high. If we were to ever get a 10 or 20% correction, we'd probably have a deal in 5 minutes.
Yeah.
But we don't have that now. So when you talk about, looking at your macro view and trying to square it with everything else, look no further than Washington's inability to get a deal, and probably the influence that a new all-time high in the stock market through all of these distortions is having in making them have an inability to get a deal.
What do you think breaks first, Jim? The market rally, the resiliency that we're seeing in equities through much of the last couple of weeks, even though Washington and talks have gone nowhere, or the resolve down in D.C.? What breaks first, the D.C. resolve or the equity resistance?
Oh, I'd have to say, at least at this point, the D.C. resolve will be a reaction to something else. They're going to need to be forced into believing that inaction is bad for them, Right now, both sides think inaction is good for them. So either it'd have to be a market break or it would have to be an economy break as well, too. Like if we were to see some of the data with initial claims or some of the weekly or high-frequency retail sales numbers take a serious dive down now that all those transfer payments are slowing down and not coming through. But I don't think they're going to come to it on their own in Washington and decide, no, now we need to have a deal as well. There's also October 1st is a debt ceiling limit, and that might be a point to push them. But, boy, that's 6 weeks away, and that's a lifetime away, especially when you're in a presidential election season.
Jim, do you think we can push it that far, just to wait until the middle, towards the end of September?
No, I don't think we can. There's going to be a lot of things that are going to happen between now and then. You know, if we're just waiting for, you know, that limit to come in to force them to have that deal, we're probably going to have to talk about whether or not there's going to be a second wave on the infection, and we're going to have a lot of people starting to focus on the election itself as well, too. The economy, we're going to get a lot more data on, and so maybe all of those things could really push us into seeing something happen one way or the other.
Hey, Jim, brilliant to catch up, as always. Enjoy the weekend, sir, won't you? Jim Bianco there of Bianco Research in this equity market.